real estate, especially when you're talking about large investments, they're a business. And they're just as much a business as anything else. And if I were to say to a lot of real estate investors, hey, have you ever run a $20 million business or a $50 million business? They'd be like, no, wow, that's crazy. But they wouldn't think twice about the idea of buying a $20 million commercial property or apartment complex. Yeah. And in reality, there's no difference. An apartment complex is a business. You have inventory, you have customers, you have your product pipeline, and you have your P&Ls that you have to manage, and your balance sheet, and you have your vendors, and you have everything you have in any other business. And if you don't treat it like a business, it's going to fail.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. I have Jay Scott with me. Yes, that is a J, as in the letter J, Scott. Someday when you meet him, you can say, why is it just a J? But for today, it is Jay Scott, and he is with Bar Down Investments. And let me read you a little bit of his bio before we launch into Jay telling us about some of my favorite topics. So Jay Scott, he does go by Jay, is an entrepreneur, investor, advisor, author, and partner at Bar Down Investments, focused on buying and repositioning large multifamily properties. In the past 14 years, Jay has bought, built, rehabbed, sold, lent on, and held over 150 million in property around the country. Jay holds strategic advisor roles in several companies and is the author of four BiggerPockets books on real estate investing, including the bestseller, The Book on Flipping Houses. Jay, welcome, and thank you so much for accepting this sort of random invite to come to my podcast. Wonderful to have you here.
I'm thrilled to be here. Thanks for having me, Christina.
So Jay, tell us a little bit more like I'm a great believer that our natural talents is part of what makes us successful in real estate. So what did you before you were a real estate person? Because I'll bet those talents inform you today.
Yeah, so I got my start in real estate in 2008 after a relatively long career in the tech industry. So I spent much of my pre-real estate career as an engineer and a business person at Microsoft and a couple other big tech companies. 2008, found the love of my life. We decided to get married. We were both working 80 hours a week in tech, and decided at that time that this just wasn't a lifestyle that was conducive to starting a family, having kids, raising a family. So we literally just quit our jobs, packed up, moved across the country, and figured we'd figure out what to do next. We ended up falling into flipping houses back in 2008, probably the bottom of the Great Recession, the worst part of the Great Recession. Luckily, we didn't know enough to think, is this a smart idea? And we did several hundred flips over the next 8 or 9 years, and then eventually transitioned into multifamily. But to answer your specific question, what was it that I was doing before that allowed us to grow our real estate business, our real estate companies? For me, luckily, I knew very, very little about real estate when we got into real estate investing. I was in my mid-30s. We had just purchased our first house that we had ever owned. When my wife suggested we flip a house, literally my response was, I laughed. I thought it was a joke because I have an electrical engineering degree and I can barely change a light bulb. But the fact that I knew so little about real estate, the fact that I was so much not a handy person, I couldn't do the contracting, anything like that, it forced me to kind of focus on the business the way I had focused on the tech businesses that I had run. It forced me to grow the businesses as a CEO and to hire the people that were good at the day-to-day tasks, at the tactical things, allowed me to focus on the strategy and then outsource everything else. So one of the reasons we were able to flip 40 or 50 houses a year, one of the reasons why we've been able to scale our business the way we have, is because I can admit that I'm not good at a lot of the things that are actually done in the business. What I'm good at is managing people, hiring people, building out systems and processes, and then scaling the business as a CEO, as opposed to trying to scale the business as somebody that's working in the business. And so that's been probably the thing that's allowed us to grow and scale more than anything we've done is that we focus our business like a business, just like any other business that's out there, as opposed to focusing on the business like I'm a contractor or I'm a real estate agent. I don't like to think of myself as a real estate person. I prefer to think of myself as the CEO type that outsources everything.
And you can see right here, bar down investments. So bar down specifically, I know you talk about it here, has a specific term and a specific reason why you chose that. So let's talk a little bit about why.
Yeah, so actually, I joined Bar Down Investments in a couple years ago. I reached out to a good friend of mine, Ashley Wilson, who is a multifamily investor. We had known each other for a long time, and she and her husband started Bar Down before I joined. Kyle, her husband, physics major from Colgate. He's our lead underwriter and analyst. But in a formal life, he was a professional hockey player. He played in the NHL. And bar down is a hockey term, and it's actually like considered the best, the most difficult way to score a goal in hockey. Basically, the puck hits the crossbar and then dives down into the goal, so it's very difficult to block. And so it's basically the epitome of scoring in hockey, and we like to think of our company as kind of the epitome of multifamily investors.
Got it. It makes perfect sense. So tell me about what you feel like Bar Down Investments. I mean, it's a big name to live up to. What is it that you guys really do and rock? What is it? I love your bio. To me, forgive me, to me, it's the perfect engineering bio. And I love it because it says exactly what you do, exactly what you've done. And I don't have to go, gee, Jay, I hear you say you've invested in $150 million, but what does that mean? Yep. Because sometimes people focus on, that piece of it instead of just saying, hey, look, this is who I am. This is what I've done, right? Very straightforward. So we get it. So what is it that Bar Down Investments does that's that same sort of like, this is who we are. This is what we do. This is why we're good at it.
Yeah. And so I think if you were to ask our investors, what they would tell you is that unlike a lot of operators out there, pretty much not our sole focus, but a large part of our focus is the back end of the deal. The thing that people don't like to talk about. Operators out there will talk about how good they are at finding deals and how many doors they have and how much money they're spending on construction. We focus on operations. We focus on asset management. And when I say asset management, I mean actually being able to carry out the business plan that we define for our properties. Typically, our properties are what are called value add multifamily. Okay. And what that means is we buy distressed assets, distressed apartment complexes specifically. And our goal is to make them not distressed. And we do that in two ways. One, we do physical renovations. So we go in and we spend a lot of money on capital expenses. We replace roofs, we fix foundations, we do all the cosmetic work. We might improve amenities by adding a fitness center or playgrounds or a dog park, all the physical things that you can spend money on. But then there's the secondary piece of that. So when it comes to commercial real estate, the value of commercial real estate is directly related to the income it generates. So being able to really improve management and make management efficient and putting in the systems and processes that drive management efficiency is what raises your income and lowers your expenses. And so we focus a lot of our time and energy, not just on the physical renovations, but the management renovations as well. Putting in a great management team, giving them the tools and the systems and the processes, or relying on their systems and processes to really overhaul the management of the complex to get the expenses down as low as possible while still being able to provide top-notch service and top-notch product to our tenants. And so what we're really good at is we're really good at carrying out that back-end implementation, that back-end business plan that both improves the physical structure as well as the management structure of the property.
I love that description. And I'll tell you why. So I've invested in real estate, as you know, for over 35 years. I started in single family, moved into multifamily, and now I invest a lot in syndications. I'm an older lady. I may not look older. Blue hair makes me look younger, but I'm an older lady. I'm over 50, and I'm at that point in my life where I'm a little like, yeah, I don't want to do flips anymore. I've done it. I don't want to do it anymore. Even my direct ownership doors are Airbnb because I've seen enough tenant tantrums and toilets and answered those phone calls and talked to those level of property management companies, because I invested primarily in like B- units, work what they call workforce housing. It was like, and workforce housing is great. I'm not objecting to it, but there's a lot of potential on-site, hands-on management involved in sofas left on the front porch and graffiti on the back of the building and garbage disposals that have crayons down them and whatever, right? All of that stuff. So I really like the Airbnb because I have property management in place. It's still singular doors, right? So I still own in the single family space versus the multifamily space. And it allows me to have higher quality units with higher quality returns, higher quality tenants. I can get in there and repair anytime I want to. My house isn't actually depreciating as I continue to own it, because I can continue to renovate it and bring it up to speed without having to wait 5 years and replace the stinky carpet. Yep. Just saying, right? And so one of the things that I've noticed, having moved from all of this active activity into this truly passive activity as a passive investor, my biggest investment is no longer just in the building. My biggest investment is in you guys.
Absolutely.
Right. It is. I'm, every time I have seen a deal go south, maybe it's the way I do my due diligence. And I have to confess, I do a lot of time in due diligence before I hand somebody $100,000. It's like if you have a Lamborghini, you don't want the valet to park it with everybody else, right? You park it in, like, take care of my car, park it in front, right? So I'm going to hand you $100,000 or 200,000, even $500,000. I want to make sure that you, the team, the crew, know what you're doing. Because whenever I've seen it go wrong, it's almost always the crew. It's never been the due diligence. My due diligence shows me that it's going to work or it's not going to work. Otherwise, I'm not going to invest. So it's really you guys. So when you tell me the back end is what you specialize in, being able to manage a project well, understanding how management needs to work, understanding how you can get performance out of your team, not that you're being mean to them, but how you value your team in a way of getting them to be able to perform to the numbers that you've promised your investors that you're going to do. That to me makes me relax. I'm like, okay, now there's someplace I can invest, because whenever I do like background checks for my clients and due diligence for them, it's almost always co-mingling accounts, having this multi-unit mixed with that multi-unit. It's like managing cash flow. I have 20 flips going at the same time, and I'm moving the cash flow that was for this building is being used on that building. Being able to keep clean books is actually potentially hard because it's a lot of moving parts. Yep. It is inherently chaotic. And I know I've done it. I've done flipping. I've had, I have to confess, I've only done 3 flips at any point in time in my life. I've not done 40, right? I am a mom and pop investor.
3 flips at once is an undertaking.
3 flips at once is an undertaking, given it's me and a project manager. Okay. I have to confess, right? But the point is, when I see the fail point, it's almost always not in the project itself. It's in the team being able to manage what's happening. So when you say that's your expertise, it makes me happy. Continue, Jay.
Yeah. So I was just going to say that's actually something that kind of disappoints me in the industry. Okay. There are a lot of people that are getting into multifamily over the last few years. I mean, we see shifts in real estate. When I started out back in 2008, everybody wanted to be flipping houses. And then by 2014 or 15, everybody wanted to own rentals. And now here we are in 2022, and over the last year or two, everybody's kind of moved into the large multifamily. And so what I see is there are a lot of mentors and gurus and trainers popping up that are trying to teach the business, and nothing wrong with that. But what I find is what they're teaching is the front end. They're teaching how to find properties, how to build an acquisitions team, how to do underwriting and due diligence, and all of this stuff leading up to the day you buy the property. And that's what they focus on, because that's as a new investor, I remember, that was the exciting thing. You want to get to the point where you can buy the property. But what you realize is this is a little bit, when you're dealing with a 20 or 50 or $80 million asset, it's a little bit more complicated than just hiring a contractor and going in and doing a renovation. There's a lot that goes into the business plan. And so what I see for a lot of new investors is they buy the property and then they wake up like the day after close and they say, now what? And they've now told their investors, we have a 5-year plan, and this is what we're going to do, but they have no idea how they're going to actually carry out that 5-year plan. And it's scary as an investor in that project to think that the person that's operating it may have no idea how to carry that out. And so one of the reasons why I think we've been exceptionally good at this, and our investors tend to be very happy, is that instead of starting out that way, we started out the other way. And when I say we, I have to give my partner, Ashley, all the credit here.
Okay.
She actually started out as an asset manager.
Okay.
She started out as one of those people who, for other operators and some big name operators that your listeners probably know, she was their asset manager. She was the one that went in and carried out the business plan. She ran construction and she oversaw property management. And it wasn't until she felt like she really understood that whole last 5 years that she said, okay, now I'm going to get into doing my own deals and learning the first 3 months, the acquiring and due diligence and underwriting and closing. And that's actually the easy part. So we kind of, because we came at it from the back end first, we're really good at that. Day after close, we know exactly what to do. And our property management team is literally sitting in the parking lot on the day of closing, waiting for the phone call for us to say, okay, it's been officially closed, go take over and get things rolling.
Do the on-site management, do the letters, make sure everybody understands where the event's going to be moved to. What are we going to do? I mean, there's a whole series of stuff up front that's relatively simple. It's really, I mean, Jay, for me, the complexity is not the upfront. I've done it a million times. I've purchased for myself, whether it's a single family, a multifamily in California, in Knoxville, Tennessee, in Hawaii, in Virginia, whatever, right? Wherever it is I've purchased in state, out of state. None of that, it feels complex to me at this point. What's actually still complex to me is the 18 problem is with the last flips I just did, which were larger flips. It was 18 months. It wasn't 6 months. It was an 18-month process. And it's like managing the inflow of the supplies and the inflow of the money, the draws from the bank, right? Being able to get the inspection dates managing all of that whole process, which is a little like a spider web being built, right? And then constantly making sure that it's being fed. That to me is where you can see a lot of falling down. That's where I've seen people just like, I had a business partner for a while that was in charge of that. And honestly, it was just it was, let's not even go into that story on a radio station that's being recorded. Let's not go there on that one. But the point is that it ends up being spaghetti. And unless you know how to manage spaghetti, it ends up falling in on itself. And you end up losing money just because you're not staying up with the processes every week, every day, whatever it is, getting the draw done at the right time. Because now you've lost a week and a half waiting for your draw to show up, or you've lost 3 weeks waiting for hopefully not 3 weeks, but I have lost 3 weeks waiting for my designer to pick the particular blah, 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 blah. And I'm like, do you have any idea I'm holding this house up at $500 a day? Now, in your world, $500 a day is not a lot, right? But in a flipping world, a $500 a day mortgage payment is like, that compounds relatively quickly. I can calculate in my head how much money you've just cost me by waiting 14 days or 15 days or 20 days at $500 a day that you've just cost me by not being able to show up on time when I needed you there.
Exactly. And real estate, especially when you're talking about large investments, they're a business. And they're just as much a business as anything else. And if I were to say to a lot of real estate investors, hey, have you ever run a $20 million business or a $50 million business? They'd be like, no, wow, that's crazy. But they wouldn't think twice about the idea of buying a $20 million commercial property or apartment complex. Yeah. And in reality, there's no difference. An apartment complex is a business. You have inventory, you have customers, you have your product pipeline, and you have your P&Ls that you have to manage, and your balance sheet, and you have your vendors, and you have everything you have in any other business. And if you don't treat it like a business, it's going to fail. And so, it's treating everything like a business every single day, not like a hobby or just an investment.
Okay. I'm going to jump subjects. If we're good with that one, I'm going to jump subjects. So economics. So I've lived through what I called 2 downturns. I love how you corrected me and you went, Christina, it's been more than 2. If you've been investing since 1986, it's actually been more than 2 downturns that you've seen, because we only recognize the large ones. but there are constant sub cycles inside of every real estate cycle. But so you have decided, and I have as well, but I suspect that you're probably as avid about it as I am, that you're following the economics. You even have a book on it. So talk to me a little bit about that, especially given the increasing interest rates that we're looking at. Why don't you give me your current, what I call stick on that one, or your mini lecturette?
Okay, let's see. Where do we get? Well, let's start with the first thing you pointed out. Yes, a lot of people don't recognize that recessions are actually a lot more common than we give them credit for.
Yeah.
Let's start with the technical definition of a recession. So the government would say a recession is if you have 2 economic quarters in a row of negative GDP. And GDP is kind of the total output of the country. If the total output of all the businesses and investments and financial institutions of the company drop for 2 quarters in a row, we call that a recession. And while we like to think of recessions as not happening that often, in reality, over the last 160 years, since the mid 1800s, we've actually had 34 recessions. So if you do the quick math, 160 years divided by 34 recessions, that tells you we have a recession about every 5 years in this country. Now, the crazy thing is the last one was the beginning of 2020 at the beginning of COVID, though a lot of people ignore that one, but technically
They do. It was there. It was a recession. It is. Yes.
But it was so quick. Everybody just kind of forgets that it existed. But the one before that obviously we most of us remember, and anybody over the age of 30 no doubt remembers, was 2008.
Yeah.
And because it was so long between 2008 and the next recession in 2020, that 12 years, that over 12 years, because it actually started at the end of 2007, that 12-year period was actually the longest period in this country's history between recessions. So a lot of people that are younger, anybody that hasn't lived through multiple recessions, the one before that was 2001. And so if you don't remember 2001, you probably assume that the typical recession in this country is at least 12 years, because it's been 12 years since 2008. But the reality is, for any of us that are old like me, we remember 2001. I remember the early 90s and the late 80s. And the reality is, this happens every 5, 6, 7 years. Now, while it happens every 5, 6, 7 years, it's not normally like 2008. 2008 was an anomaly. 2008 was a crazy downturn, only outdone by the Great Depression back in the late 1920s. So when we talk about recessions, it's natural for a lot of younger folks and even some of us older people to think 2008 is what a recession is like, but in reality, it's not. Most recessions are a lot less impactful. A lot of recessions, you might have unemployment that goes up a couple points. You might have some foreclosures and people losing their houses and people losing their jobs. And it's not fun. I'm not going to sugarcoat it and say.
And it's regional. I mean, you have certain, it depends upon what's the recognized trigger, because the recognized trigger is different and it can be different. And then the fallout from it's like any systems, right? Here's the thing that popped. Here's the thing that moved significantly. And then there's all the fallouts from it. So, but it ends up being like, gee, sometimes you don't feel a recession at all if you're in storage, or you don't feel a recession at all if you're in single family, but you're going to feel it if you're in hospitality or right? Or California versus Texas, or Boise, Idaho, my favorite example. Boise, Idaho.
Exactly. So the first thing is that, recessions tend to be a lot more frequent. So we were very fortunate that we went 12 years or longer without a recession this time. Number 2, most recessions aren't nearly as bad as 2008. And then there's a number 3 that's really specific to us because we're real estate investors. Most recessions don't impact real estate the way 2008 did.
Yes. It's not as expensive.
Exactly. Absolutely. Yeah. Every recession has a different cause. And so if you go back to like the 70s, we had several recessions in the 70s, mostly caused by inflation and high oil prices. In the 80s, in the late 80s, we had a recession because of this thing called the savings and loan crisis. If you're not 50 years old like I am, you have no idea what that means. But basically, there were a whole bunch of bank failures in the late 80s that led to a recession. If you remember the 2001 recession, so any of us that are over 30 probably remember what led to 2001. It was the tech businesses. Yes. It was the internet downturn, and it was 9/11 in 2001. And so I didn't mention real estate with respect to any of those recessions.
Right.
But then you get to 2008. And 2008 not only was a recession that impacted real estate, it was actually caused by real estate. Because we had all of these really bad loans that were out there, banks were packaging up these loans into what are called MBSs, basically collateralized securities, and then selling them off. And then all of these foreclosures led to the defaults for all of those collateralized securities, and the banks started to fail, and then the loans got just all kind of collapsed. And so 2008 was, again, it wasn't a typical, it was a typical recession, but it was led by real estate. So real estate was hit a lot harder than it normally is. If you look back to 2001, real estate barely took a hit. If you go back to the late 80s, real estate took a hit in the late 80s. But then if you go back to the early 80s and the 70s, real estate actually went up. And so not every recession does real estate get hit. And 2008 is not what typically happens with real estate. So if you're a younger real estate investor and you're thinking, you hear the word recession, and the first thing you think is 2008, change that attitude. I'm not saying real estate is immune to getting hit. I'm not saying that bad things can't happen, but the likelihood that the next recession or the one after that or the one after that is going to look anything like 2008 is very slim, very remote. More likely what it's going to be is we're going to see people losing their jobs, and we're going to see some inflation, and we're going to see some people losing their houses, but it's unlikely to be a 2008 type event.
That was my question is, I personally believe we're in a recession currently, but we can't declare it.
Yep.
Right?
2 weeks, 1 week, a week from today.
A week from today, the government can be able to go, hey, guess what? We're in a recession in case you haven't noticed.
Yep.
Right? And they will, and then it'll hit the newspapers and everybody will go, we're in a recession. Right.
Yep.
And then all of a sudden, lots of people will be concerned. But those of us who are in the financial sectors or in the real estate sectors, we are well aware of this, right? The stock market has already responded. They have been responding for the last 2 months, 3 months. As soon as interest rates increases started becoming obvious and meaningful. We already are seeing a significant downturn in the stock market, but not necessarily in real estate, because we have this funny inflationary factor while we're also aggressive inflationary factor while we're also increasing interest rates. I hear lots of people, and let's keep it to real estate, which is hard, right? Because there's the GDP, then there's the stock market, then there's real estate, although real estate is probably about as big as the stock market, given the actual sheer size of real estate and the dollars in real estate. I think the stock market itself might actually be smaller, but right. But less, but real estate fluctuations are less observed and people are less worried about it. Sorry to get into all those nuances. Maybe you can describe that another time.
Yep.
But the point being is, how is this interest rate increase going to affect real estate in your opinion? And feel free to pull out, if you want, residential from stocks, so residential from storage, from triple nets or industrial if you want. Why don't you give me a clue what you think? Because I have my beliefs, but I want to hear yours.
So let's start with the bigger picture. So we can talk about what's going to happen tomorrow, but I think tomorrow is less important than what's going to happen 2, 3, 5 years down the road, because if something bad happens tomorrow, but we find out it's going to be okay in a couple of years, that's not as bad as if we find out something bad is going to happen tomorrow and it's going to keep getting worse for the next decade. So going back to history, and I'm a big fan of economic history, things don't always repeat, but they tend to. There have been, over the last 60 years, there have been 10 times where the federal government, the Federal Reserve, has had to raise interest rates to quell inflation. So inflation is obviously price of stuff goes up for whatever reason. We don't have to talk about that. But the way that the government deals with inflation is that they raise interest rates. And raising interest rates does two things. One, it encourages us to save money because we're making more money in our savings accounts and our CDs. And two, it discourages us from spending money because everything's more expensive. We can't buy a house for as cheap or a car for as cheap. Our credit card interest rates are higher. So we risk, if we're not paying off our credit card every month, everything's more expensive. So between saving more and spending less, raising interest rates basically slows the economy down. There's less money moving through the economy. When there's less money moving through the economy, there's less demand for products. When there's less demand for products, businesses lower their prices to get people to buy more. And so in order to slow down inflation, we raise interest rates. And again, over the last 60 years, we've had 10 times where the government has started raising interest rates to lower inflation.
Mhm.
All 10 of those times have led to a recession
I've
within 12
noticed.
months.
Yes, all you
Within
should do is look
12
at a
months.
chart.
Yep.
That's
Yep.
right.
And so what's likely to happen here, and like you said, we're probably already in that recession. It hasn't been officially declared.
Right.
July 28th, I don't know when this is going to air, but July 28th is when the Bureau of Labor Statistics.
It will be after July 28th at this
Okay.
point. Okay.
So everybody's
this is the crystal ball, guys. Here you
There you
go.
go. There you go. See if Christina and I are right that on July 28th that
They're
we've been
declaring we're
declared
in a recession.
in a recession. So that part will hold 10 times in a row, and hopefully, not hopefully, but probably 11 times in a row, interest rates will lead to a recession.
Right.
All 10 times over the last 60 years that's happened, within 16 to 24 months, the Federal Reserve has then lowered interest rates because they want to get us out of a recession. They want to restart the economy. And how do they do that? They lower interest rates. Lower interest rates have the exact opposite effect. People save less because you're making less money from a savings account, and they spend more because everything's cheaper to buy on credit. And so within 16 to 24 months, what we're likely to see is that the Federal Reserve is going to lower interest rates and get the economy back on track. 2 to 3 years from now, we'll probably have interest rates back where they were 6 months ago, and we'll probably be back on track. That's the other thing. We talk about recessions, and we talk about recessions being fairly common. The other thing that we tend to see with recessions is, let's say the average length of a recession or the average length of a cycle between recessions is 6 years. About 4.5 years is an expanding economy, the economy getting better. Recessions actually last a very short period of time, 12 to 18 months. Again, 2008 was kind of an anomaly. We saw that lasted actually technically only about 2 years. It seemed like a lot longer, but typically recessions last 12 to 18 months. So if we're in a recession as of July 28th, well, we're already 6 months into that recession because it takes 2 quarters of bad data to get us there, which means we're probably 6 to 12 months now from the technical end of this recession that we're in.
Okay.
So not saying the next 6 to 12 months can't be not fun.
Right.
And a lot of people could lose their jobs, and it may not be pretty, but it's not a decade long problem. And so I think that in the next 2.5, 3 years, we're going to see things back on track. We're going to see interest rates back where they were 6 months ago, and everything's going to be good. So that's kind of my kind of guess crystal ball at where we're going to be 2 to 3 years. In terms of what we're going to see over the next 6 to 12 months, one of the nice things about real estate, and this is one of the reasons why real estate tends to be somewhat counter-cyclical or moves differently opposite to the stock market and other asset classes, is that when we're heading into a recession, it's typically because we're seeing inflation. Because remember, recessions are caused by raising interest rates. Raising interest rates we do because we're seeing inflation.
Right. Yep.
What do people do what do investors do when there's a lot of inflation? They move their money out of the stock market, they move their money out of crypto, they move their money out of other asset classes, and they end up putting it in real estate because real estate is literally the best inflation hedge out there. Real estate tends to move with inflation, and fixed rate debt, getting loans, is probably the best way to hedge inflation on the planet. So when we're seeing inflation, when we're heading towards a recession, people are moving money out of the stock market and they're moving it into real estate. So a lot of times you'll see the stock market dropping, but you don't see the real estate market dropping the same way because all that money that's coming out of the stock market, some of it's being lost, but a lot of it is just being moved from the stock market into real estate because people are preparing for that recession. So even though interest rates obviously aren't good for us as real estate investors, we can't afford as much house, so it's going to push prices down a little bit. We're still seeing a lot more demand because a lot of money is moving out of other asset classes into real estate during that recession. So I do think we're going to see a softening in real estate. I think there are several markets that have been so hot over the last year, 2 years, that we're going to see a downturn in some markets. But for the most part, I don't think it's going to be, again, anything like 2008. I think there are going to be some markets that might see a retraction back to 2019 prices, which, don't get me wrong, that could be a 20-25% drop. There are going to be other markets that are going to soften where we see more inventory, fewer sales, but we're not necessarily going to see lower prices. And then there are going to be markets that may even continue to do well because one of the big truisms from COVID is that there's a huge population shift going on in this country.
Yeah, there is.
And so if you live in an area where people are moving, I live in Florida. Tons of people moving to Florida. If you live in Florida, Texas, North Carolina, Arizona,
Right.
there are areas where there's so much population growth that even if interest rates are up and houses are more expensive and people are losing their jobs, there's enough people coming in that it's going to prop up demand, it's going to prop up prices. And we may even see places that see price rises over the next year or two, even though we're in a recession. So I do think there are going to be some places that suffer. I do think that there's going to be some softening. But I don't think that the next year or two is going to be that bad. And I think then we'll be right back on track. And this is coming from somebody who is a eternal pessimist. So I wrote a book.
You don't sound that way.
I know, I don't. It's crazy. I wrote a book called Recession-Proof Real Estate Investing that I published back in 2017 or 18. And I wrote it. It basically details what to do throughout each phase of the economic cycle, where to be if you're a real estate investor in each phase of the economic cycle. And so I didn't write it because it's not just for recessions, but I wrote it at that time because I felt like we were heading towards a recession. Again, this was 2017, 18.
Right.
I was wrong. I was 3 years from 2020, and then we had 2 big years after that. So I tend to be pessimistic. This is the first time that I'm probably more optimistic than most people out there on where the economy is headed for real estate.
For real estate. Specifically, yes. Like let's be clear, we're talking about a specific subsection
Absolutely.
Inside of the U.S. economy. Jay, I'm going to call you brilliant, but maybe it's just because you think the way I think. So I'm projecting onto you my bias, my bias, which is I think this book, because it's the same conversation I'm having with people when they do my economic updates, economic conversations. I'm like, guys, look, if you're talking about real estate and you're talking about residential in particular, any version of residential, right? And the supports for residential, like a multifamily storage and mobile home parks. I think almost all of those are not going to have a problem, especially if you're paying attention to this sort of regional sensitivities. We're really short on housing units. We have people who have moved demographically into areas that don't have enough housing to support the people who are moving there.
Yep.
This is not going to be a problem on the residential. The problem is in the stocks, right? Yep. And that's where interest rates, because they've been manipulating the stock market and the quantitative easing coming to a stop, that's where we're going to see the biggest immediate effect is in that market, especially since that market is so, in my opinion, it's volatile because it's so short term. Whereas people think of real estate as being stagnant because it's so long-term, right? It just takes 3 months to close a real estate deal, whereas you can have 3 seconds, you can sell a stock, and therefore it leads to a high level of volatility inside the stock market. So to me, it's like, that's way too volatile a vehicle for me to be able to try to contemplate its cycles, right? I want to do long-term cycles in stock, and I prefer to do long-term cycles in real estate, and real estate is just not as volatile. So I'm with you on all of that. Right. So thank you, Scott, or Jay. Thank you. That was a lovely, lovely description. So we have just a few minutes left. So I want to get to, actually, we have 2 minutes left. Do you have a hard stop?
No, I do not.
Oh, okay, cool. Are you okay with, we ran a couple minutes over?
As long as you want.
Okay, cool.
Having fun.
Having fun. Me too. Having fun. I have extra 30 minutes. So let's talk for a minute then about real estate is cyclical. It breathes in, it breathes out. Get comfortable with it. So does the economy. It breathes in, it breathes out. You just got to be as comfortable with the exhale as you are with the inhale. Yep. Right. So, but that also means that problems arise, things go wrong. And part of real estate is the expertise and the knowledge and the network. But the other piece is being able to problem solve, not losing your head, not throwing up your arms and walking away, but staying committed to your investors and being able to be the one that's going to come up with a solution. So tell me about something that went wrong, what you learned from it, how you solved it.
Yeah. So if I think back to all the things that have gone wrong, and lots of stuff has gone wrong, but most of them, not most, but a lot of them come down to one aspect of my business, and that's been working with partners. And so I
laugh of recognition over here. I apologize.
Yeah. And it probably doesn't surprise anybody that's been in the business for 10 or 15 or 30 years, that partnerships can be very difficult. But I find that for people that are new to the business, one of the things they assume is a partner is a great way to get traction and to overcome all of our problems. They don't think about all the problems that bad partnerships can cause. But a lot of the problems I've had in this business have been partnerships. And one of the things I found is that as you get towards a downturn, towards a recession, a lot of us get in situations where we need a partner. Maybe it gets harder for us to get a loan, so we're really good at finding deals and doing the renovations, but we can't get the loans, or maybe vice versa. And so a lot of us will look and seek out partners. And so, having had a number of bad partnerships, basically, I've learned that there are a number of questions I need to ask myself before I get involved with any partner. And the big five. So just real quick. So number one, I always want to know, what's the history that I have with this person? So is it somebody I've known for a long time? It's easy when you meet somebody to think everything's going to be great, because it's just like going on a first date. You go on a first date, everybody's on their best behavior. They're going to be nice to the waiter, and they're going to leave a big tip, and they're going to compliment you. But any of us that have been in long relationships know that what you see on the first date isn't necessarily what you get after a year or two or five. Same way with partnerships. So having that history and seeing the bad side of somebody really tells you where things might be headed. Number two is just simply agreeing on the vision. So do you agree with your partner on where you're headed? One of the biggest mistakes that I've seen made with real estate partnerships is two people that don't agree on how much money they want to make. And I know that sounds crazy, but put yourself in a situation where you're an investor and you're thinking, if I could make $100,000 next year and only have to work 30 hours a week, that is the ideal lifestyle. I've accomplished all of my life's goals if I can do that. And then you partner up with somebody whose vision is, I want to make $1 million next year and I want to build $1 billion company. Are those two people going to have a good partnership?
No,
probably not.
Yeah, they have to, yeah.
The person that wants to make $100,000 is going to be miserable because the other person's driving them too hard. And the person that's making $1 billion, as soon as the company makes $100,000, one partner is going to decide, okay, I'm done for the year. I've gotten everything I want. So agreeing on the vision is huge. Number three is just who's in charge. So we like to think that like a partnership is 50-50 and it's a democracy and we all make joint decisions. But the reality is that doesn't always work that way. I mean, you take a vote with two people and a lot of times you're not going to come to consensus. So in my business, my partner and I are 50-50, but I've said from the beginning, at the end of the day, she's in charge. If we disagree and she wants to veto anything I say, we've agreed that's how, and because we can agree on that, it makes things a lot easier. Number four, would you work for your partner and would you want to like have your partner work for you? Because a lot of times in business, we have this relationship where I need to act like your boss for some period of time. You're working for me. And then in other situations, you're going to be acting like my boss. Yeah. And so if I can't work for you and you can't work for me, or I can't manage you or you can't manage me, it's not going to work because you're going to have that power struggle. Yeah. And then finally it comes down to the skill sets. So too many people I see jumping into partnerships because they say that person's exactly like me. They're really good at all the things I'm good at. They enjoy all the things I'm good at. We're going to get along great. You might get along great, but the business isn't going to be great because you guys now have twice as many of certain skills and still zero of other skills. So if you want to find a really good partner, find somebody that has the exact opposite skill set of you, somebody that has the strengths where you have weaknesses and the weaknesses where you have strengths, and that's going to make a good partner. And so kind of any partnership I go into these days, those are the 5 questions that I always ask. And if I don't have good answers for those, I say, let's hold off.
You know, I love that. Visions in particular, like, I mean, all the other ones I've heard before, but having the same vision as to how you want this to go, that to me is the one that I hear the least often. And I feel like is particularly important because it's subtle. It's in the languaging. Oh, we both want to be successful. Oh, we both want to have an empire. Oh, we both want to have, both want to have multi-units. And I'm like, yeah, I get that. I hear that the words are the same, but is the vision the same? Because you want to have one multi-unit that's got 30 doors and he wants to have 5 multi-units with 300 doors, each complex. And like, those are 2 very different visions. And that will absolutely. And it leads to arguments that people don't understand why they're arguing.
My goal is to take a 2-week vacation this year. Well, your goal might be to do the same thing, but you want to buy a private jet to do it.
Right.
And so we get there in very different ways.
But get them in very different ways. And having that conversation, I like you say, it's a marriage, right? It's a first date, and then it's a long-standing relationship, and it's like a marriage. And, part of the beauty of a marriage, the moment of getting married, is the stress beforehand that challenges each partner to see how you guys work as a partnership while you're doing this project called getting married. And if getting married means that you guys almost want to break up before you ever get to the altar, there is some feedback in that. And it's the same thing. Like if you're not willing to have a conversation, like a prenup, before you ever get to buying the project, and you guys are going to break up before you ever get to the buying just because you tried to work out those details and you're scared that's going to create a breakup, that already is a red flag for me.
Yep.
If you can't have the conversation, if you can't work out the details, well, how many kids do you want to have exactly? How many doors do we really want to have? How many doors do you want? What state are we wanting? Are we wanting Class A, or are we wanting workforce housing? What are we investing in? Those conversations define the success of your partnership just as much as defining where you're going. Those conversations define the success of the actual partnership and being able to work together. So I love that you bring that up. That to me is a subtlety that I think other people have missed. So that being said, real estate is not always easy. We have recessions, right? We have partnerships. We have partnerships that don't work. I have as many partnerships that have not worked as partnerships that have worked. Then why do we use real estate to break through to our financial freedom? Because that is what we do. That is the name of the show, right? Real estate breakthrough. Why do we use real estate to break through to our financial freedom, given the level of challenges it can give us?
Yeah. So for me, I love real estate because there's so many different ways to make money. And regardless of where I am in my professional life or my financial life, I can use real estate. So for me, for many years, like I think I mentioned, I flipped 450 or so houses over 8 years. That allowed me to build up a war chest of cash. Basically at the time, and I actually regret flipping so many houses. If I had to do it over again, I would have held a whole lot of those houses. But it allowed me to build up a ton of cash that gave me some level of financial security. And so that's one thing real estate allowed me to do. But once I had all that cash, real estate then allowed me to take that cash and start creating cash flow. Mm-hmm. It allowed me to start creating an ongoing influx of cash that I could live off of potentially forever. And so not only did I have the ability to make large buckets of cash through real estate, I had the ability to take those large buckets of cash and convert it to cash flow. Mm-hmm. Well, here's the next thing I found. When I went back to doing more of the getting large buckets of cash, which I've been doing through multifamily, well, now I realize I'm in this ridiculous tax bracket. And so I'm paying a lot of money in taxes. And let me tell you something, when I was 20 years old, 30 years old, even 40 years old, I didn't appreciate how much money I was losing to taxes. But now that I'm really old, I'm starting to realize all that money I'm losing to taxes, I don't want to be losing. And so real estate, unlike most asset classes out there, also gives me the ability to offset my taxes, to push it out some amount of time, or to get rid of them completely if I do things really well. And so I'm building my war chest even faster because I'm not losing all this money to taxes. And then finally, real estate, because of the ability to leverage, I now have the ability to buy this real estate for relatively cheap today. I can get in for a relatively small amount today. And as long as I'm willing to hold it for 15 or 20 or 30 years, I now get to enjoy the full benefit, the full value of that real estate after my tenants or whoever it is now paid off that mortgage for me. And so between the cash flow, between the equity growth, between the tax benefits, between the loan pay down, basically no matter where I am in my financial life, I can move money around in a way that I'm either generating buckets of cash or I'm generating cash flow. And ultimately that to me is financial success.
So they're perfect. That makes, I agree with all of that, of course, because being a real estate investor of my own. So what does financial freedom mean to you? So you're able to buy your life. You're able to move money around. You can earn buckets of money. You can earn cash flow. You have choice over your investment flow. Why? What's financial freedom mean to you?
Yeah, so it started out again when I left my job in 2008. my sole goal was basically to start a family and raise a family and allow me to put my family before my work. I never wanted to miss a soccer game. I never wanted to miss a piano recital. I never wanted to have to say, I have to travel and I can't see my kids. And so that was the original goal. And I was very fortunate that I was able to achieve that goal. And then my next goal was, now I want to make enough money so that my kids have that same opportunity, so that my kids don't ever have to worry about raising their own families and not having enough money or not being able to spend time with their kids. And I was very fortunate that I was able to achieve that goal. And now my goal is, not only can I take care of my family and my family can take care of their family, but now I can start taking care of other families. And now I've started to think more about, what can I do philanthropically? What can I do to make other people's lives in the world a better place? And so that's kind of my goal now. And I luckily, that's such a big goal that I'll never be able to achieve it. So I don't have to really worry about what the next one is.
Yeah.
But now that's kind of what I focused on. And so for me, the goal of what I've been trying to achieve with real estate is ever changing. But no matter how big the goal is, so far, real estate has allowed me to get there.
Jay, thank you so very, very much. I love it. I love your answer. It's fascinating to me. Most people, when they answer that question, that goal is control over time. And yet what you're talking about is completely being able to create a difference moving forward. You're not really looking to stop working. You're looking to continue to, you're like, no, I still want to have a reason to get up. I still want to be engaged. I still got stuff to get done. I just want to know why I'm doing it.
Yeah, I'd be miserable if I ever stopped.
Yeah, me too. Me too. I did stop and I was miserable.
Yeah.
So I started it again. Jay, thank you so much. How do people get a hold of you if they want to invest in bar down investments? I did get that correct. In bar down investments, how do they get a hold of you? How do they get a hold of bar down investments? How do they find your books? Give us some information.
Yep, I'm going to make it really easy. If you go to www.connectwithjscott.com, and that's just the letter J, www.connectwithjscott. That'll link you out to anywhere. If you want to invest with me, if you want to find my books, if you want to send me an email, if you want to meet up, just www.connectwithjscott.com.
Thank you, Jay. Wonderful having you on the show. This is Christina Suter with Real Estate Breakthrough. You can see us on iHeartRadio, Spotify, and iTunes, as well as on Roku TV and YouTube. See you guys next week.